So with businesses failing and unemployment in the mid-teens right now, demand for many commercial real estate product types is the lowest we've seen in over a decade. And with real estate rents based on the supply of available space and demand in the market, this is likely going to mean decreased rent growth or even rental rate decreases overall in many US markets over the next 6 to 18 months or more. And if that happens, this could create some serious ripple effects in the commercial real estate markets, aside from landlords just being frustrated when new leases are signed at lower rates. So if you're thinking about investing in real estate in the near future and want to know how to best protect yourself from the chaos that might ensue if rent growth comes to a standstill or even moves negative over the next few years, make sure to stick around for this video. Hey, this is Justin from BreakIntoCRE.com, and if you're new here, on this channel we talk about real estate investing careers and real estate financial analysis. So if you're looking to break into the industry or do your first real estate deal on your own, make sure to subscribe and hit the notification bell so you don't miss any new videos as soon as they're released. So for the last 3 months, rent growth has been slashed across almost all major US markets, and many markets have seen market rental rates actually move into negative numbers as a result of business closures and tens of millions of job losses across the country. Now, office, retail, and industrial leases tend to be long-term by nature, and lease terms range anywhere from about 3 to 10 years on average. And even though these sectors have seen their fair share of tenant bankruptcies and lost rent, decreased rental rates on new and renewal leases haven't had the opportunity to have a major effect on commercial leasing yet, with only about 10 to 20% of commercial leases expiring in every 12-month period. However, because of the short-term lease term nature of multifamily housing, the residential sector is being hit particularly hard by this right now, since a large percentage of multifamily leases expire and need to be renewed every 12-month period, which makes multifamily extremely sensitive to market rent changes in the short term. And so far from what we've seen, the bigger and pricier the city, the harder these areas have been hit, with major US metros like Boston, New York, San Francisco, and San Jose seeing new lease rent cuts of over 8% in May, according to RealPage data. And according to CBRE projections from April, multifamily rents are projected to drop a full 6.7% from Q3 2019 to Q3 2020 before a recovery in rents starts to occur, meaning that rents likely have much more room to fall in many secondary and tertiary markets before we see the floor of multifamily pricing across the country. So for commercial real estate investors, what does this mean and how big of an effect will this have on the commercial real estate market? Well, first, for properties that were acquired with a value add strategy in 2019 or early 2020, this could have a much bigger effect on these deals than it might appear on the surface, with an impact that's more severe than just a few years of lower rent and lower cash flow to investors. Now, to understand this completely, it's important to note that rent growth compounds. So if rents were $1,000 this year and grew at 3% throughout the year, rents for that same unit would be $1,030 the following year, representing a rent growth of $30 year over year. But in the following year, that rent basis is now $1,030 instead of $1,000, and a 3% rental growth rate on that value now turns that rent into $1,061, a slightly bigger increase of $31 over the year. Now that might not sound all that significant, but where this gets important is when rents start to slide and market rent growth actually goes negative in the year. So similar to stock market investing, where a 50% portfolio value decrease requires a 100% increase to get back to its starting point, the same concept is true for real estate rents. And if an investor underwrites a deal with expected rents of $1,000 per unit, but then rents in that market are cut by 10% in the first year of ownership, even with 3% annual increases after that first year, it would take that property almost 5 full years to get back to that original $1,000 rental value that the property started with in the first place. And where this really becomes a problem in real estate is with hitting projected returns, especially for investors with a short-term hold horizon that rely on a projected sale value to hit their target IRR, equity multiple, or total profit values on a deal. So, for example, let's say that a property was acquired in January of 2020 with a business plan to renovate the property, stabilize the deal, and then sell that property at the end of 5 years of ownership. Let's also say that the property was in a hot market that had seen significant rent increases over the last several years, and the investor projected 4% increases for the first 2 years of the hold period, and then 3% increases in the remaining 3 years of the analysis. Now, taking all of this into account, using our investors' base case assumptions regarding loan metrics and property sale value, that deal would be projected to produce a 13% IRR, a 1.7x equity multiple, and an average cash-on-cash return of over 8.8% over that 5-year hold period. But then let's say that the market gets hit with CBRE's projected rent decrease of 6.7% in the first year of ownership, derailing the business plan and property rent growth projections. Well, in this case, with just 1 year of negative rent growth, even assuming the following year would still produce that 4% rent increase that the investor initially projected, that IRR value drops from over 13% to just 0.3%. The equity multiple drops to just above 1.0x, and the average cash-on-cash return drops over 300 basis points to just 5.8% for the entire 5-year hold period. And even if CBRE's projections don't end up materializing, even slighter market rent decreases in that first year would still derail return expectations pretty significantly. So a 3% drop in market rents in that first year of ownership would drop the IRR to just 5.3% and the equity multiple to just 1.25x. A 1.5% drop in market rents would drop the IRR and equity multiple to just 7.14% and 1.35x respectively, and even flat 0% market rent growth in the first year of ownership would drag that IRR value down over 400 basis points for the entire hold period, down to 8.9%, and that equity multiple would be dragged down from over 1.7x to only 1.45x on the deal. Now, this is really important when taking a look at overall return projections, but is also especially important today with certain popular debt structures, specifically loans with a short-term interest-only period. And for many deals that are coined as value-add opportunities that rely on raising rents significantly in the first few years of the hold period to meet those debt service requirements after that interest-only period burns off, this can be a big problem if rent growth targets aren't hit during that interest-only period in the first few years of ownership. And this is especially true for deals in major US markets that have been acquired at sub 5% cap rates, which would otherwise be in a negative leverage situation if amortization payments had to be paid in the first few years of the loan term. So for example, let's take a look at a deal that's acquired at a 4.99% cap rate and planned to be held for a longer term 10-year hold period. Let's also say that this loan has a 2-year interest-only period, meaning that only interest payments will be paid for the first 2 years of the loan term. Now, assuming, again, 4% rent growth in the first 2 years of the analysis, that cash-on-cash return would fall between 7% and 8% during that interest-only period, and then that cash-on-cash return would fall to around 4.4% in year 3 once principal payments start coming due. But if we assume that gloom and doom scenario of 6.7% market rent decreases in that first year of the analysis again, and again assume market rents bounce back quickly to 4% growth in year 2, that cash-on-cash return value still drops to just 1.7% in year 3 of the analysis and drops that average cash-on-cash return by almost 300 basis points to just 3.6% per year over that 10-year hold period. And while not hitting targeted IRR values and cash-on-cash returns isn't ideal, where this could get really detrimental and could potentially expose investors to increased default risk is when short-term loans come due after rents have taken a hit and the property needs to be refinanced. So in this same scenario with the property being acquired at a 4.99 projected cap rate in year 1, the property in our example would produce an expected $897,000 in net operating income in the first year of the investor's hold period. But if rents dropped by 6.7% in the first year of ownership, taking into account expense growth as well, it would take that investor until year 7 of the hold period just to get back above that $897,000 net operating income figure. And because properties are valued based on net operating income, this could spell a lot of trouble for the investor that took out a 5-year loan upon acquisition when the property appraises at a value lower than what it was acquired for 5 years earlier when that investor ultimately needs to refinance. And if the property is valued lower than it was upon acquisition, that likely means that refinance proceeds won't be able to cover paying off the existing acquisition loan balance, meaning that equity investors would have to dip into their own pockets to cover the outstanding loan amount not covered by refinance proceeds, which obviously isn't an ideal scenario for anyone. So with all of this in mind, assuming you're thinking about investing in a deal in 2020 or 2021, how do you protect yourself from situations like this going forward? And how do you reduce your risk of default and falling short of investor return expectations if rents do continue to slide for the foreseeable future? Well, first, make sure that you're being conservative on your market rent growth assumptions and potentially even incorporate negative growth assumptions in the first 1 to 2 years of your analysis on new property acquisitions, depending on the market that you're in. And the reason why is because, as you've seen throughout this video, real estate returns are extremely sensitive to rent growth changes early on in the hold period, so being overly optimistic in the first few years of your analysis can have major negative effects on your actual returns to investors if rent growth falls short of your underwriting assumptions in the first few years of owning the deal. Now, aside from being conservative with rent growth assumptions, the second thing I'd recommend is to make sure that the deal still pencils without an interest-only period, assuming that burns off in the first 2 to 3 years of the loan term. And doing this will decrease the chances that you'll run into a negative cash flow scenario when the interest-only period burns off, and will decrease the odds that you'll have to make an unexpected capital call to investors to cover operating expenses and debt service to avoid foreclosure by the lender. The last thing you want to do is get too aggressive on assumptions on a bad deal in order to prop up cash on cash returns in the first few years, only to have investor distributions be wiped out in year 3 or year 4 of your hold period if rent growth assumptions aren't hit. And finally, the third thing I'd recommend is to lock in long-term debt if possible to give you maximum optionality if things don't go exactly as planned on the deal. So a loan term of 7 to 10 years or more will give the property time to recover in the case that your market does see considerable market rent decreases, and you'll decrease your refinancing risk significantly as a result, while also giving yourself additional flexibility of when you actually decide that you want to sell the property. So overall, it's better to be safe than sorry in an environment like this, and conservative assumptions go a long way towards finding profitable deals where your downside is protected. Now, if you want to see the impact of different market rent scenarios in this model, I'll link this file in the description below. And if you want to see how all of these acquisition, operating, loan, and sale metrics come together to create a real estate financial model, make sure to check out the free Breaking a CRE Real Estate Financial Modeling crash course, and I'll link that in the description below as well. And if you want to take a deeper dive into real estate investment analysis and modeling and how to analyze deals from start to finish, also make sure to check out Break Into CRE Academy, which will give you access to all Break Into CRE courses, all models, and some additional one-on-one support from me. So I hope you found this helpful. If you like this video and want to see more content like this, make sure to hit the like button and subscribe to the channel so you don't miss any new videos as soon as they're released. Thanks so much for watching, and I'll see you in the next video.